Good afternoon, everybody. Thanks very much for coming along to listen to SGX talk about Singapore stocks for the next 20 minutes or so. My name is Jeff. I am the market strategist at Singapore Exchange. This is my 12th year at Singapore Exchange, and principally on these weekends, my role is an educator, just to bring investors up to date with recent developments in the market, what current macroeconomic drivers are, what micro factors are working behind in the company financials, and help investors make informed decisions. So that's a quick disclaimer on what we're going to talk about. But what I would like to talk about, and hopefully everyone can hear okay. If you cannot hear, please put your hand up and we'll maybe sneakily turn the volume up a little bit. So last year, Singapore's stock market was the strongest, pretty much the strongest in the world for much of the year. Right up to the end of the year, the only index that actually outpaced the STI and is considered to be a global benchmark was the B3 Brazil SPA index, which was up 1% more than the STI. The STI generated a price return of 4.1%, with reinvested dividends boosting that total return to 8.4%. Now, what I want to do is just spend 5 minutes explaining why that outpacing occurred, two key reasons, and what implications that might have for the remaining of this year. So, when you look beyond STI, you can see here's all the indices on the chart, and you've got some broad benchmarks there in the bottom right corner. And you can see STI was up 9% in US dollar terms, while FTSE Developed Index was down 18% in US dollar terms. FTSE ASEAN Index was down 6% in US dollar terms. So one key difference of our Singapore stock market is that we obviously are a key financial services hub across the world, and financial services transcend into the STI as an important cornerstone sector. So at the end of 2022, the three banks alone made up 47% of the STI weightings. Now you compare that to the FTSE Developed Index, banks make up 6% of the index. You compare it to the FTSE All World Index, banks make up 7% of that big global benchmark that takes into account all the stocks listed across the world. So we are very overweight in banks, whereas your big global benchmarks like the All World Index or the Developed Index is very much overweight in technology, which was actually the worst performing sector across the curve last year, based on higher operational costs through supply chain pressures, labour costs and inflation and energy costs and so forth. While at the same time, the technology sector had to contend with a reduction in demand impacting sales, and thus the outlook for margins was quite significantly reduced for tech sector, which makes up the big top sector of these big global benchmarks. Now, as we said, banks generally outperform or perform better when interest rates are rising. I'll go into that a little bit more, but into the next slide, and explain how that occurs here and the relationship between the interest rates in the US and the net interest income and net interest margins of the Singapore banks here. But suffice to say, and I'll ask the audience if you can answer this for me, and I'm sure you can. It wasn't just the overweight in banks, because you consider that we started the year last year, I think, with around 44% weight of banks in the STI, end of the year 47%, because the trio of banks outperformed last year with an average 13% total return. But you look at the FTSE ASEAN Index. The FTSE ASEAN All Share Index has a 31% weightage to banks. So it is comparatively overweight in banks as well. It's comparatively overweight in banks. So of that 31%, 11% is represented by our three banks, DBS, OCBC and UOB. And then there's a remaining 20% from the other banks across Southeast Asia. So if banks were so strong, Why is the FTSE All-Share ASEAN Index down 6% in US dollar terms, where we are up 9% in US dollar terms? The answer was the actual currency. The Singapore dollar actually helped the performance of Singapore stocks comparative to other stocks. In fact, when you look at last year, you had the Singapore dollar beginning last year at 135, it ended at 134. So it actually appreciated slightly to the US dollar, albeit did decline to around 1.42 in the third quarter of last year before coming back to actually end 2022 marginally higher than where it started. By comparison, your Indonesian currency depreciated 9% to the US dollar, your Malaysian ringgit depreciated 6% to the US dollar, the Thai baht declined 5% to the US dollar, India declined something like 10% to the US dollar all last year. So that has impacted the SGD or the USD denominated returns of those indices. So that is a key reason. And does everybody understand why we appreciated? Because the MAS actually embarked on tightening, albeit modest tightening, all the way back in October 2021. There are other central banks in the region that was still maintaining a very dovish outlook in November of 2021, whereas the MAS had actually started with a very slight, modest appreciation of the slope of our nominal effective exchange rate all the way back in October 21. So right through to the end of last year, you had 3 slight raisings of the slope, you had 3 recenters of the band, so much monetary policy that at the moment the outlook for monetary policy tightening in Singapore is actually balanced between tightening or non-tightening. In fact, most expectations for the April meeting is that the MAS will stand pat. Okay, so that core goes to the MAS policy as to why we've defended those returns so much. So enough about that. Just looking into the STI, as we said, banks around 45% of the weight of the STI, a very important part. Why did the banks make so much money, as shown in the bank's combined net interest income? So at the end of for the third quarter of this year, you had DBS, OCBC and UOB, the 3 banks together, reporting combined net interest income of 7.4 billion Sing dollars. That was up 1.3 billion from the second quarter alone. So there's a record net interest income. Together for the 3 banks, net interest income comprises around 65% of the total income of the 3 banks. Now, net interest income is driven by 2 things. Net interest margins, which when you look at DBS, in the third quarter of 2021, net interest margin was 1.43%. At the end for the third quarter of 2022, the net interest margin was up at 1.9%. That has increased with US dollar and Singapore dollar interest rates. The CEO of DBS, with the third quarter business update, maintained that if the US Fed funds rate does peak at 4.75%, he would expect the net interest margin rate for DBS to reach as high as 2.25%. But at the moment, as we've seen, a very big week for financial markets, the FOMC minutes did have a slightly more hawkish tone, and we do expect the peak rate for US interest rates right at this very moment to actually be at a rate of between 5% and 5.25% all the way from May through to November of next year. That is the most recent expectation gauge of where we expect US rates. So net interest margins rise, that increases net interest income. But it's not just that, it's also the size, the span, the health of the loan book. And all 3 banks have been able to grow their loan book in the mid-single digit percentage level last year with guidance that they will continue to expand that. Now, that's 65% of the income. There's also the non-interest income, important part, which is very much overlaying with those regional sub-themes of the widening middle class and the need for wealth management services and digitalization and so forth. That is a really important part of the business as well. And then the third end, when you consider there's non-interest income, there's net interest income, there's also NPL ratios, okay? Non-performing loan ratios. And all 3 banks did reduce their NPL ratios in the third quarter of last year from the second quarter of last year, okay? So why this is important, for our stock market, 26% of the day-to-day trading turnover of our stock market actually comes from those three banks alone. And that is up from 21% in 2021. And they are super important for investors. In fact, the biggest trade I've ever seen in my experience at SGX was retail investors buying DBS in 2020 and selling it in 2021. So in total, we saw net retail inflows of 1 billion Sing dollars across 2020 when the VWAP, the volume weighted average price of DBS, was at around $21. And then in 2022, we saw around 1.1 billion Sing dollars of net retail selling in the stock of DBS when the volume weighted average price was above $28. So that was a 35% inclination. That's the biggest trade I've seen. So as we say, it's important because these stocks, they don't just make up more than 40% of the STI, they make up 26% of our day-to-day turnover. But it's not just all about the three banks. We've also got a lot of geographical exposure in our stock market. So when you take our STI, 50% of the revenue thereabouts is reported to companies operating or businesses streams within Singapore. Then another 50% is actually generated from outside Singapore, the majority of which is reported with our most trade-weighted partners, Southeast Asia, China, and Hong Kong. So what happens in China has a very big bearing on our stock market here. If I could take 3 minutes just to explain that in terms of what happened on Thursday. So we had 4 trading sessions already this year, and just in those 4 trading sessions alone, we've seen as much range between high and low in the STI in those 4 trading sessions as we saw for the entire month of December. 2 key reasons: those more hawkish FOMC minutes saw banks strengthen on Thursday, and we also saw 3 very important developments in the China economy through the course of the week. The first was the new foreign minister, Qin Gang, his appointment and his conversation with Anthony Blinken, and the promise for better relationships between the US and China, or the potential at this stage. You also had the Chinese regulators approving the finance, the $1.5 billion US dollars for the financing of the consumer unit of Ant, very market-friendly development. And then, of course, you got tomorrow, China opening up its international travellers. Why is that important for Singapore? 1 in 5 travellers coming into Singapore actually come from mainland China. In 2018, prior to COVID, in a report in 2019, there was 150 million outbound travellers of the China economy. So this is a very, very important reason why the market rallied on Thursday. And a very important reason why, when you look at which stocks actually outperformed in the STI last week, it was the likes of DFI Retail Group, Jardine Matheson Holdings, Hong Kong Land, stocks that are very sensitive to the outlook for the China economy, stocks that actually outperformed in the last 2 months of last year on the potential for China growth basically being revised upwards, and at the same time underperforming for the first 8 months of first 10 months of last year based on those zero COVID optimization policies. Well, I mean, basically, there's one more factor in our stock market. As I said, it's not just macro, there's also micro at work, and very important. Last year, so STI generated that 8.4% total return. GDP growth at the moment, we expect it to be at 3.8%, exactly half the 7.6% rate of 2021. And we also booked 500 million of net fund inflows across our broader stock market as measured by the FTSE ST All Share Index last year. The returns of our sectors very much mirrored the returns of sectors globally. So last year, globally, energy stocks were the outpacers, but we don't have much energy representation in the STI, albeit through Sembcorp Industries and a little bit of Capital Corporation. So that didn't have too much impact in the STI. REITs declined 15%, so that did drag down the STI more than it might have if we weren't so overrepresented by REITs in the Singapore stock market. So globally, REITs make up 2% of the global stock market, but they make up around 11% of the Singapore stock market. So we do have a little bit more exposure into the REIT market, which actually helped weigh the STI last year somewhat. point I'm sort of trying to show you is that we're a very trade-centered economy. We're very much a globally driven stock market as well. And at the same time, if you look at those 10 stocks that saw the most net fund inflows last year, 7 of them have recently embarked on significant strategic initiatives. Strategic initiatives that have include asset disposals, asset acquisitions, complete restructuring, pivots to new businesses, basically in the name of adding value to shareholders or unit holders in the case of the REIT market. Case in point is Singtel. So Singtel, its net profit for the first half of its current financial year came to $1.2 billion, which was boosted by that $1 billion net exceptional gain from that partial stake in Bharti Airtel. And that followed the divestment it did in FY22 for its 70% equity stake in Australia Tower Network. So there's strategic initiatives at play, providing the value, seeing the stock book the highest net fund inflows last year, other strategic plays as well, and very thematic going into the budget on 14 Feb is the NCS business as well, which is now its own autonomous unit in the Singtel group, gradually increasing its revenue, while at the same time positioning Singtel and NCS in particular as a digital regional champion. You might have seen in October last year, NCS worked with IMDA to put on 1,600 jobs in the next 2 years in the direction of increasing its digital businesses. This is important because come Feb 14, as we saw in the budget last year, the finance minister said digitalisation is a first priority for the Singapore economy, and upskilling the employment force to work with these inherently very strong regional themes is super important. There's a number of other examples. We could just list them out. 10 or so stocks in the STI. You've got Keppel Corporation as well and its Vision 2030. City Developments has made significant disposals under its growth enhancement transformation strategy. We've got Sembcorp Industries transforming its brown portfolio to a green portfolio. And of course, Sembcorp Marine and Keppel Corp also working together to bring this new unit in play. And then you've also got CapitaLand Investment, which back last year restructured itself into a real estate investment manager from the traditional developer that it was. When you look at these fund flows, it's not just important just to look at the size of the fund flows, but also the size of the fund flows proportionate or relative to the actual size of the stocks. So in some cases, you can see significant net fund inflows in a stock or net fund outflows in a stock when you're comparing it, the size of the stock or the market capitalization, market value of the stock as a baseline. Case in point is Sheng Xiong Group, which emerged somewhat as an inflation play last year, with the head of Sheng Xiong Group maintaining that when times are tough, that consumers can tighten their belts a little bit and are more inclined to buy the fresh produce from Sheng Xiong than go to the restaurants and so forth. So the Hourglass is another consumer stock, which is on the other end of the consumer spectrum, which also attracted significant funds last year as a proportion of the market cap. So last year, to sum it up, I've got 1 minute. You basically had global stock and bond markets very much repricing in the recessionary pressures that we do expect to take on 2023. Okay, so much was priced in, and at the moment, much of the world's growth is expected to be in this region. But there are downside risks. The fact is, global interest rates could rise quicker than we expect, but there's also upside risks, such as the reopening of China economy, buoying the stocks more. So we have a number of economic focuses. There's the QR code. Please do scan that if you would like a copy of the slides and join our Telegram channel. We got so much to say. I could be here for 2 hours, but it's not going to happen. But if anyone would like to come along to SGX and we can talk more, we can run Q&As, we can do virtuals, whatever you like. We'd love to work with you more this year and see if we can help in, as I said, the education, the information, and the intel, and so forth. All right. Thank you very much.